Dear guests, welcome back. I hope you're having a fantastic time so far here at the Finance Magnates Africa Summit. Please take your seats as we're about to start our next panel, All-Star Panel, Top Analysts Share Easy Tips and Hard Lessons. Joining us once more on stage is the Chief Currency Analyst at ForexLive, Adam Button, who will introduce his panel. Adam, the stage is yours.
Well, thank you very much. This is probably the panel I'm most excited about, and I've done a few of them here today. So listen, we get to talk about just trading in markets in general, tips, things you've learned, hard lessons. There's always a lot of hard lessons on markets, but the nice thing about that is it leads to personal development. But I want to start and let you guys each introduce yourself. Why don't we start on that end and talk a bit about what got you into trading? I mean, there's a lot of new traders here. What sort of pushed that button that led you to a career in financial markets? And tell us about your firm and who you represent.
Yeah, good afternoon. Thanks for the opportunity. It's great to be here. Nice to see a decent-sized audience. My name's Rob Pietropaolo. I commonly go by Robbie P. I guess I got into trading just like everybody else in the room. You're trying to find different ways of supplementing your income. But then it grabbed me. The day I finally got it, I decided this is what I wanted to do for a living. I then did an apprenticeship at an asset management firm, got onto the trading desk, wrote all the exams that you needed to write, and made a career out of it. I now head up the trading desk at a firm called Unum Capital, where our division is Unum Trade, co-head of trading, and we are, besides asset management, we are a multi-platform, multi-asset, multi-broker provider. So we, on the other side of directly interacting with your Forex brokers or any other kind of broker for that matter, we go and find the best product, best platform that suits our clients' need. So tailor-made solutions for our clients, because we've learned that everybody is different. It's not one brush paints all. And we've grown from strength to strength. I think my CEO has had his license for 31 years. So we've been around, and very proud to represent Unum Capital and Unum Trade.
Great. Roger, why don't you tell us, is there any event that you remember early on in your trading career that really pushed the button for you or got you excited about financial markets?
I think it was my first loss. They say you learn a lot more by losing than what you do from winning. So like most other people, I dabbled in university and started buying shares and started buying trading shares. And the first loss was quite material, because it taught me how quickly something can go. And it was probably, in hindsight, the most valuable lesson. And this is what we try and tell our investors at Tickmill, is that one's got to know thyself and play to one's strengths in terms of your trading abilities and your knowledge. Tickmill, as you know, is one of the big five in the world, and we're proud to be in South Africa. We're an ODP license holder, and it's a fascinating journey. I'm more into the long-term asset management, the multi-asset portfolios, but trading is something that's very close to my heart as well.
Robert, why don't you tell us about what got you into markets and who you represent?
Thank you very much for having me here. Very similar to Rob and Roger, I started at university, and I started through technical analysis. But when I was growing up, technical analysis was a bit of a voodoo word, because all the books were written by fundamentalists. So technicals was really frowned upon. I started at university. I took a long journey. I've always been involved in financial markets. I was a head of research at Standard Bank in fixed income, currency, and commodities. And then I went into stockbroking. I've managed Tebe stockbroking, Absa stockbroking, FMB stockbroking, and then currently I am looking after Scope Markets. So Scope Markets, similar to what Roger said, we are an ODP, similar to Unum Capital. We provide an online trading platform, a global online platform. And then I also wear another hat. I am the author of The Badass Trader, which was published in South Africa. So I'm pleased to announce it's on Amazon.co.za. And if you haven't seen it, it reached bestseller in South Africa about 2 months ago. So it's The Badass Trader. Thank you. And I think what I'll be doing in this presentation, Adam, is basically to share my views in terms of the knowledge I put into this book.
Well, great. I'm looking forward to hearing more about that. You know, what strikes me is early on in trading, there's so many young people here, and sometimes it's good to start young because, you know, that you take some tough losses early on, and then you look back and maybe they weren't, you know, as big a dollar figure as the painful lessons that you have to learn early on, and then it comes to be valuable over time. But I also want to talk about the changing nature of markets in your career, and especially right now. You know, you used to talk with people in person, or you used to trade in a room with other people, and then it went more digital and now social. And you know, how have markets changed, and what are the opportunities that are coming with that now, in your view?
Look, I think diversity in asset classes is a wonderful thing, because if everybody only traded Bitcoin, either everybody would win or everybody would lose. And I think diversification is key, and that's exactly why we offer the various asset classes that we can at Unum. The way that social trading has influenced markets is actually ridiculous, and brokers such as ourselves need to sit up and pay attention. Everybody's out there to make money. How you make that money is what counts. In the old days, I think I'm old enough just to have missed the trading floor.
Yeah.
But I think everything changed when we went digital. The speed of information changed the industry forever. Where you used to read it out of a newspaper and on Monday morning phone your broker and say, I want to buy Anglo-American. Now, news flow is instantaneous. Price action is instantaneous. And we as brokers need to keep up to the demands and the needs of clients, because time is everything, especially in a trading environment. When you're in the longer term sort of asset management game, time is your friend, because that's how you make a lot of money in the market. Time is your friend. But with the change, and especially at Unum Capital, where this came to the fore was during COVID and the lockdown periods. We saw our revenues skyrocket, record month after record month after record month, because we were all locked in our houses and we had nothing else to do. And that's where we saw a new client come to the fore. And those clients didn't only trade one thing. They didn't only trade Forex. They didn't only trade shares. They didn't only trade commodities. They traded everything they could get their hands on. And that's why we've identified that the more you can offer, coupled with experts in those assets, we're out there to keep we call ourselves your profit partner. And if you keep your clients profitable, you will succeed as a broker, as a stockbroker. And I think the change, the speed, the immense amounts of instruments there are out there to trade is a wonderful thing, because it leaves room for everyone in the market.
Yeah, and I always tell people they need to learn how to trade it. It might come up. There might be an opportunity. You know, Roger, a lot of people here will tell you to trade, but you were talking about long-term investing and the value in that. And how did you come to that way of thinking? Oh. There you go.
There we go. There we go. The power of compounding. And when one sees this happen at a fund level, which is kind of where my expertise lies, is, you know, one sees the compounding of a bigger base over time. It truly is the eighth wonder of the world. But the problem is this relentless impatience that people have with immediate gratification. And there are certain times when you can be opportunistic in a trade and you can get in and out, and I think that's a lot of everybody gets stimulated by that. But there are other times where definitely impulse is your enemy and time is your friend. And there's a wonderful equation that depicts the power of compounding, which is 1 to the power of 365 gives you 1. 1,01 to the power of 365 gives you 37.7. Just that 1%, that basis point compounding over a longer time. So really time is your friend. And I think this democratization of trading is both a good thing and a bad thing. We were talking about our old days, Robin, at RMB, when we were doing bond trading, you would still the scooter boys would still deliver the script. You know, that's how you would get receipt of your bond script. You know, the guy would physically have to get it. It's a completely different world now. I mean, the proliferation of information that's available to investors is astounding. And that can be a good thing and a bad thing, because as much as information, there's a lot of hubris and a lot of skullduggery techniques. And we know that there's nothing more dangerous than a person who knows a little bit about everything. So, like with anything, you've got to know yourself, know your strengths, stick to it, and understand yourself before you go, whether it's long-term trading or short-term trading or building a portfolio for the rest of your life.
What are the lessons you've learned along those lines, Robert?
So I agree with Roger. I do believe when you start trading, so there's investing and trading, my recommendation for most people is to follow a core satellite approach. The core of your money or your capital you should be investing. And the easiest thing, and that's even backed up by Warren Buffett, is just to put it in an ETF that tracks an indice. So that's the core. And that should be about 80% of your money. And you won't do wrong. You'll be earning roughly about 10% a year. 10% is not great, but it's better than nothing or losing money. The problem with investing, it's not exciting. You can't go to a braai and say, I've got my money in an ETF. That doesn't get anyone excited. So for the remaining 20%, you should be trading. And again, you know, your question is what has changed? The barriers of entry have changed quite a lot. In the old days, there were a lot of barriers of entry in terms of opening up accounts, access to markets, access to information. You can pretty much open an account right now. There are a lot of vendors out there. Within 5 minutes, you've got your account. You can start trading a multitude of instruments, leveraged, non-leveraged. There's a multitude of information. You know, CNBC wasn't in existence about 20 years ago. Bloomberg's wasn't around. So there's a lot of opportunity to trade. But I would always go back to the principle of having a core portfolio with solid investments that track indices, and then for the racy stuff and for the excitement at the braais, trade away.
Yeah, and I think, you know, you guys made a good point about, you know, following and all the news and bombarded, and it seems like it chases people from one asset to the other, but there's a lot of value in finding the things that people aren't talking about right now. It's not, you know, the things that go up another 5x from here aren't the things that people are talking about now. They're the things that no one's talking about, or the things that no one's paying attention to. And with all the news and information in the world, you know, you can tune into things like that and look, you know, away from where everyone else is looking. Because I found it's very difficult to get an edge where everyone else is looking. And you know, what are some of the lessons that you've learned sort of in your long career in trading?
Well,
Painful lessons, preferably.
I'm going to piggyback a little bit on what Roger said. Trust me, every single client loses money. It's how you handle that. In fact, I think a lot of brokers lose money at the end of the day when their clients don't have longevity. But in the trading universe, I think the most important lesson that I've learned is if you can't sleep at night, your trade is too damn big. Yeah. And if you don't know what your risk tolerance is, how much pain can you take, and how much pain your account can take, then you should rather try something else and get back into it slowly. And
or trade smaller, right?
Just trade
nowadays,
smaller.
I mean, it used to be in the old days you had to trade big lots or you couldn't trade at all. Now you can trade fractional anything.
100%. And I think if you just manage the risk, it's okay to be wrong, because you only need to be in a leveraged environment, you only need to be right 50% of the time. But where everybody falls down is they watch those losses accumulate and do nothing about it and sit and cry in front of that screen. And if I could teach every single one of my clients to not do that, they'd become very, very wealthy in a short-term trading space.
That's great. Anything to add to that?
I think over the years, one is constantly humbled by the markets, and overconfidence can be your biggest inhibitor and your biggest detractor. But probably the biggest lesson I've learned over the years is that the pursuit of alpha, which is a market return or return in excess of what the market gives you, beta, and pain are both sides of the coin. As an example, so if I go and buy an ETF or an index, I'm going to get the index performance, bar a few bips on tracking error. But if I really want to try and outperform the market and get alpha or the outperformance, there's going to be times when I'm wrong, and there's going to be times when I'm right. And for often you can be for a long time where you're wrong, and you got to embrace that discomfort and say, this is my goal, this is my objective, this is what I firmly believe in. And unless the fundamentals have changed, or the business case has changed, or something new information has come up, if you believe in an idea and you have the courage of your convictions to go whether a small size or an outsized bet, and you're trying to outperform the market, there are going to be periods of pain, and you've got to learn to embrace that discomfort. And even more so with traders, because they go through this on a daily basis, and they've got to face a number of biases that we know can inhibit intelligent decision making. So once again, it's knowing thyself, becoming afraid with what your personality allows you to do. If you're a 6'3" athlete who's lots of fast twitch muscle fiber, you're not going to go and train for the decathlon. You're going to go and train for sprinting. So know yourself and be true to yourself, and only then can you practice your craft.
But there's no way to avoid the pain. There really
There's
isn't.
no way.
And if you're not sleeping at night, you are trading too big. And everyone's had those sleepless. And I remember being early on in trading, very small positions, waking up, checking my phone, and even then, you just knew that something wasn't right, and it just leads to compound bad decision making.
That's 100% right. And also listening to too many people. But I remember as a broker on the trading desk, I hardly had any sleep because our exposure across our book was so high. I used to wake up in the morning, let's take it from when the Johannesburg Stock Exchange opens, then watch the US session all night, have a couple of bombs of coffee, and wait for Asia to open, and then I'm buggered by the time the JSE opens the next morning, and it was killing me. But you do it because you love it, and this is your life. But the day I learned just to manage expectations and manage the risk and accept that losses are a part of the game, because the winners will make up for them if you keep your discipline. I started feeling more comfortable in the advice that I was giving. I didn't have to stay up all night and lose sleep and see what's going to happen tomorrow, because there's nothing you can do about it. What you can control is your emotion and where you draw the line when you're wrong, and where you're going to be happy to spoil yourself a little bit when it comes time to take profit.
Wonderful. Robert, why don't you tell us the secrets of your book, and maybe not all of them, but some of them.
So the book was written because I've been dealing with a lot of clients over many years. So I've had very clear insights in terms of what people are doing wrong. The first thing, I'll just share two. So the first thing is, when you place a trade, you don't know the outcome of the trade. It's impossible. It's random. But I never knew that when I got into the markets. The thing that I was obsessed, and I won't ask anyone to raise their hands, I was obsessed by a system with a high win rate. The higher the win rate, the more excited I got. I was even willing to pay money for a high win rate. But that's only one part of the equation. Adam, you mentioned the word edge. So there's a whole chapter in the book about edge. In terms of trading, you need a trading edge, which is a function of your win rate. And Rob mentioned it can be as low as 50%. The other part of the equation is basically your risk to return ratio. How much are you making or losing per trade? You should not be losing more than once And on average, if you're doing 50% win rate, a 2-to-1, you would be doing handsomely well. So there's a whole chapter on that. I've saved you about 30, 40 pages.
I don't want to give too much away, but there's a common theme in a lot of what we're saying about pain and about someone was asking me on a talk yesterday, this trade you had, and it was a very successful one that I talked about, and they're like, how did you stay comfortable in that? And I said, oh no, it was deeply uncomfortable every step of the way, and the way I work in markets is we trade don't trade every headline, we write about every headline and watch every headline, and that's what I do. And so you're always getting news that goes against your thesis, that challenges your conviction, and try to manage and say, okay, is this a game changer? When do I really need to perk up and say, listen, it's time to get out? And it's one thing to say, all right, there's a stop loss, but you talked about long-term trades, Roger. How do you know when to say, you know what, I was wrong without being too frightened, because we've all been on the side where you were right and you got out too early?
Yeah, that's a great question. And for me, what is important and what has become very evident over time is the skill. It's part art and part science. The skill of calibrating your risk with your time horizon. Let me explain that. So, I'll use a current example, for example. I'm currently very bullish on China as an investment destination for a number of reasons, which, purely from a valuation perspective, it's incredibly cheap. You marry that to the US, which is looking fundamentally expensive on many metrics. It's starting to reflate China, but for many people, China is uninvestable.
Well, that's a word you like to hear sometimes when you're looking to buy. If everyone's saying it's uninvestable, it's not expensive.
They're not happy with the current communist regime or the way things are handled there. So if I look at China now over a 6-month view, it looks ridiculously risky. And every morning I wake up and there's bad news and there's more, and that could alter my perception over time. But if I keep the end in mind and I look at China 3 years, 5 years, 7 years plus, the risk perception all of a sudden becomes much lower. And if you understand what you're trying to achieve, and you say, right, I'm investing in China, and I've got this 5 to 7 years for this thing to play out, there's a couple of 10, 20, 30, 50 baggers in there. But if you're looking on a 1 year, 6-month horizon, you're going to drive yourself nuts on Valium.
Great. I mean, I love to hear about your ideas or things that you're watching right now. For the rest of you people, I talked about China yesterday, so when you hear that word uninvestable, or I remember Microsoft maybe 15 years ago. Everyone was saying Microsoft, if you can believe it now, was uninvestable, and now it's one of the biggest companies in the world. It's been straight up since then. So that I think a lot of those words you look for as a more experienced trader is trying to gauge the sentiment and find things that are hated, and then trying to get out of the way when everyone is maybe too enthusiastic about something. I've been on the copper trade, and suddenly it feels like it's everywhere. And then you start to say, well, wait a second, now is this the top, right? So what are the things you look for indications about whether to get into a trade or stay in a trade? Or get out?
I'm a little bit biased. I do believe in not listening to too many people. Don't listen to too many headlines. It clouds your view, and it does interfere with, as Roger said, with what your goal is. If you don't know what your goal is, why are you getting into the trade in the first place? And so I really try and avoid all these fancy analysts' expectations, and I look at whatever the instrument is based on its own merit, where I think this could go, and cut out all the noise. Look, your broker is supposed to be your buddy. If he's there to offer advice, you can ask him for advice. If you don't like what he has to say, by all means, go to somebody else. But the biggest mistake people make is they go and look for too much information on one specific thing. And that goes all the way back now again to diversification. So Roger likes China. He hates it over 6 months, but loves it over 7 years. I hate Sasol over 7 years, but I love it over 3 days. And it's the flip side of that, but essentially every analyst in the country will tell you, don't buy Sasol. This company is in trouble right now. They've overinvested. There's not enough. They've sold off all their valuable assets. Don't buy it. But when the results come out less bad than what the market expected, I'm happy to own it for one day and make myself 15% on a leveraged basis, of course. So that's the only advice I can leave is cut out the noise, don't listen to too many people, and you'll be just fine.
What are your thoughts on that, Robert?
Yeah, I would agree with that. I think you have to keep it simple because I think one of the challenges through my career as well is to complicate it. So again, if you go with your core, where you just buy the ETF and S&P 500, you actually don't care about those 500 companies because they'll be rebalanced every quarter. And then if you do for trading, so I'm a price action trader, so my entries and my exits are based on technical indicators. And I'm very much, if it comes up on some sort of screening model, I'll have a look at it, but I don't get clouded by fundamental view because I can't. That's not my style. The fundamental view drives the ETF, but it doesn't drive my trading.
Where is your focus right now? Like, what are things you're looking at and markets you're watching?
So obviously the hot stocks at the moment is NVIDIA. So we're all waiting in a bated breath this afternoon what it'll do. Will it go to 1,100 or will it go down to 850? So at the moment the Magnificent Seven is quite hot at the moment. So I'm pretty much in all of them, except with Tesla. Which is, again, if you look at the fundamentals, they miss earnings and then they go up. It just doesn't make any sense. And then you mentioned the copper trade as well. I was speaking, he's sitting here at the moment. I was speaking to one of my mentors. I'm looking at copper at the moment. I'm in gold. So anything that moves, I'm in. I'm a trend follower.
Great. Why don't you tell us where you're at?
Well, similar to Robert, I'm also more of a technical trader, but there's certain things that I'm starting to hear whispers about, especially from a local point of view. All eyes are on the elections. I have a bit of a double view on whatever the outcome might be. The status quo surely cannot be kept in place. But it's going to be an interesting thing. But some of the whispers I've heard is in the local banking sector. These guys are starting to, even now, make revenues that they were making before COVID. So just like Robert, that perks my ears, and I go look at the charts, and I look at the banks within the sector that interest me. And when any of those start to outperform the others, that's where I'll jump in and stay on as long as that trend is in. So for me at the moment, with the elections very, very closely in the background, I think the next sector to fire is going to be local banks.
Just to add to that, I think it's a great sector to watch. If you look at a bank like Absa, for example, I think it's on a 9% dividend yield with a 6 or 7 times price to book. You can't get those metrics in any bank anywhere in the world for a bank that is as well capitalized with such a diversified source of revenue as Absa. And the same can be held to a lesser extent for Standard Bank, First Rand, and Nedbank. But so financials excite us. South Africa excites us for the first time in a long time. Hanging our hat on a positive, uninvestable.
Well, it was, right? That's where you want to look. And money fled South Africa as badly as anywhere. And from the outside, any bank that's been able to survive the last 100 years in South Africa must be pretty well run.
And once again, I was talking earlier on in the other session there, everything depends on the price you pay for it, right? That's the bottom line. How cheap or expensive is it? And on a valuation metric, some of the South African companies are trading at ridiculous multiples. It needs one catalyst, one bit of good news, one positive coalition, one honest politician. We could just one bit of bad news, and the leveraged effect of that is incredible.
I mean, we saw it in Argentina that, like, you know, there was an election there last year. Now a little bit of a different state of play, but it got the market excited about a place that was in far worse, you know, that had declined just to an incredible extent. And the money came in. There is a lot of money in the world, and if it can find a story it can get behind, growth, you know, it will come pouring in, and to be ahead of it is an incredible wave to ride. And I think, you know, a lot of the traders, and I talk about too, it's not that hard to get a good idea or to hear a good idea or to believe in a good idea. How do you stay invested in a good idea? We talked a bit about holding that conviction, blocking out the noise, but you know, what do you set those goals ahead of time and say, all right, I'm not out until this is 10x, or am I going to take a little bit early on, or am I going to set stop losses? What are some techniques there that traders can actually use? Anyways, there you go.
Yeah, that's the good question. I think when you get into a trade, you need to, firstly, you need to know that you don't know the outcome. Given that you don't know the outcome, you need to set a stop loss. As boring as it sounds, a stop loss is a necessity. So in terms of what I've written in the book, you would initially start with a break-even stop loss that you cover your initial investment. And then one of my favorite stop losses is basically an average true range stop loss. So it ratchets up with the market. As the trend goes up, it ratchets up quite neatly. And I would start tightening it up as well going forward. And then when it breaks the stop loss, drop it like it's hot. Get out. Don't think about it. Don't dream about it. Just get out and look at the next opportunity. The market is flooded with opportunities. Don't get hooked on one share, stock, FX pair, or whatever.
Yeah, that was something I said yesterday. There is always another trade, and there's a lesson in that, and there's a lesson in staying in the game. You know, I said it a lot yesterday. You know, these are three people who have been in the game a long time, and they've seen a lot of people fall out or fall off and fail, and it's usually too much leverage, too aggressive, and chasing yesterday's opportunity, or not letting go of one that you missed, even though, you know, you saw it coming. It might be banks, you know, everyone here might watch the bank shares double and then get in and then get burned by it, and you know, being frustrated that they had this idea and missed it. You want to talk?
So perhaps a good example would be, if we look at the returns of, let's say, the JSE last year. So the JSE did about 11% last year. And of that 11%, 10.5% came between the months of January and November. So if you're a long-term asset allocator and you're talking to clients, and clients are saying to you, but hang on, I can get 6 or 7 risk-free in the bank. After tax, you've got to remind them, after tax they're getting 3.5, 4. But you must remember that now for February, it's a negative number. March, a negative number. April, a negative number. May, a negative. And you keep opening these statements and you keep seeing the value of your investment dwindling. That's when it comes to the emotional staying power. If you had just waited till December, or November when we had that late rally, you would have done almost 3 times after-tax cash. But I can't tell you how many clients actually capitulated and say, I haven't got the stomach for it. And that's just over a short period. That's just over a year. So the short-termism obsession about short-termism is very bad for the long-term investment mindset.
And you add in leverage, and it just makes it almost impossible to stay with it.
You know, I think it was Charlie Munger who said, the 3 L's that'll kill you: ladies, liquor, and leverage.
Well, what I'd like to add is it's very important that it goes back to time being your friend. So it's much easier to stay when the trend is in place. I don't think there's any professional that has a short-term leveraged trading account without having long-term proper money. And I said it earlier, long-term makes you very, very rich. Short-term gives you the kicks and gets you quick money. Hell, I bought myself a return ticket to London just off my trading account in 2 days. That's what that's for. That's the fun money. So I guess what I'm trying to say is you've got to build up your own portfolio. Staying in is not the problem because you'll know when you're wrong. Your account's going to tell you when you're wrong. And you sell the losers and keep the winners. It's as simple as that. People often overcomplicate things. So for me, I mean, I trade my own, I don't want to say trade, I invest my own retirement annuity. I have the ability to do that. I just appoint a manager, but I'm allowed to push the buttons legally. But that's where the long-term money is. That's going to look after me in a couple of years' time, a few years' time. But the trading account is where I have fun. So that's where I play inside the noise and put earphones on the long-term money and let it ride until I see that I'm wrong. And then you can replace that because there will be another opportunity.
I'm going to open it up for questions. If anybody out there has any questions for anyone on our panel, we'll have someone come around with the microphone. I see a few hands coming up. So yeah, I'm happy to speak to whatever it is that comes up.
Hi, thank you so much for gracing us with your presence, guys. Just a quick one. I just wanted to ask, just the pain of getting into a trade after you've analyzed for so long, and then it finally goes into your direction, but you get scared and you close your profits early. What sort of just advice for a retail trader would you give for us to be able, because you talked about risk to reward ratio. If your risk to reward ratio is 1:2, if you can't capture the twos, you're basically doing 1:1 all the time, and you're just like, over the long run, you're going to be losing
Well, I'll
your
talk
account.
about the technique that I use and that I tell people to use. Is to visualize the trade, visualize the pain of the trade before you get into it. Know it as much conviction as you have that you are going to be tested, and think of yourself struggling to stay into that trade and hold that conviction and all the challenges, all the noise that's going to bombard you and the doubt. And I think that prepares you a little bit better for that. And then a lot of it then comes back to experience and having been there before, because you are going to blow it a few times and it's going to be painful. And then when you do, don't blow up. But I don't know if you guys have anything to add to that.
Well, I'm going to be a little bit controversial here. Because just as painful as it was for you to watch that trade go against you, finally you get slightly into the money, but the technicals have changed. It might have broken a support level, it might have broken the trend, there might have been a gap down or something. But the one thing I will tell you, and this is my personal philosophy, is nobody ever went broke taking a profit. Doesn't matter how small it is.
Other questions? Oh, okay, good. They like that. I think we have one over here in the corner. Where's our mic? Oh,
hello. Cool. Afternoon. My name is Chabu Souls. Thank you so much for being here, guys. I just wanted to pose a question to the panelists. You guys have been trading. I know Rob has been over 3 decades, if I'm not mistaken. And the question that I have is that, given the emerging technology. The emerging technologies out there in regards to trading. How does one start off and set themselves up from being a trader to transitioning into becoming an investor?
Yeah, that's an interesting question. So that's the back to front method. So usually I recommend people to take 10% of what they're earning, if they're earning a salary, and put it into an ETF, and then they start trading. But if you're not in that position, again, with trading as well, I think it's very, very critical. I'm not sure who's heard of Jesse Livermore. He was a very, very famous trader, but he lost everything and actually committed suicide at the end. But one of the things that he used to do was to reward himself. So I'm a big proponent, if you do take profits and you make profits, maybe take 10% away, 20% away, and put it into index tracking ETF.
anything to add?
I think one, in terms of your question of transitioning, one's got to look at your own personal journey and where you are in life. You know, are you a corporate person? Are you an entrepreneur? Are you self-employed? Do you have multiple income streams? Do you have any side hustles? And I think what a lot of people forget, or they don't realize, is that for somebody who's working and getting a salary, they are essentially, their biggest asset is they are a fixed income, long duration bond, provided they don't get fired and they still have that regular income, which they can now start investing in the core and satellite approach and building portfolios. And when one understands that and one changes the perspective, it then allows you to invest or change your asset allocation to match what you already have. So as a young person of 30 to 40 years old or even younger, you should be invested for at least for the next 20 years in high risk equities, because you already have that offset in your salary to build up and slowly invest. But there's no need, unless you have the need to draw an income or to draw down portfolios where you can't afford volatility, you should really have a very high risk equity portfolio of good quality equities diversified around the world, and building up a core of alternative assets, some gold, some bonds, commodities when the time is right. And over time, just build different buckets of different asset classes, so you're building a tanker as opposed to just having this one or couple of speculative trades.
All right, well, thanks so much, guys, for joining us. We're just about out of time. You know, when I think about the conversation, you know, what stands out to me is, you know, these repeated lessons about how it's difficult, how it's painful, how there has to be losses and there's personal growth from that, which is the upside of it. But if you can stay in the game and take a long view, you know, there are great benefits and great rewards in this business. So thanks so much for joining us, and thanks for the audience for having us here.